Hello and welcome to the Small Business Briefing. I'm Brian Calley, CEO of the Small Business Association of Michigan.
Hi, good afternoon, and thanks for joining us today. I'm Sarah Miller, Vice President of Operations. I want to start off by welcoming one of our new premium members, Rebecca Merrick, and her team at RM Home Services. So, Brian, last week the Federal Reserve cut rates as expected, but what did they signal about what comes next?
Yeah, there was definitely signals that there was concerns about the job market, and the job market concerns seemed to outweigh inflation concerns. But um, felt that the chair of the board, Jerome Powell, kind of went out of his way to diminish expectations for a rate cut at the December meeting at least. And so that was something that people were really kind of most at the edge of their seats for. The inflation reports from last month, or I guess it was the month before now, that we're into November, but the inflation reports came in right where they were expected. So again, a bit elevated from where targets would be. They've been kind of stubbornly stuck at that high 2 point something or 3% for many months now. And so they came in right as expected. Um, and there is still lingering concerns there. So basically, I think the words that he used were a rate cut in December were far from a foregone conclusion. And that's a pretty direct statement to make with respect to interest rates. And so you definitely saw in the longer term rates respond to that, kind of repricing the expectations because it wasn't that long ago, leading up to this most recent rate cut, there was some talks like, that they were heading into, getting the rates down to a more historically normal level. Because even though we have seen now a few rate cuts, it's still those rates are still elevated. So at this point, it really is going to depend on future data. And also, the other thing that was kind of interesting is that yet again, it was not a unanimous decision. That there were a few governors on the board that and they called it Federal Reserve Board of Governors, technically. Um, there were a few of them that voted no because they wanted bigger rate cuts. There was one that voted no because they wanted it to stay the same. And so we're actually getting into, it's not totally unprecedented, but a bit unusual to not have that board unified on the direction to go. It definitely is starting to show some signs of division in terms of where the main concerns are. That's not particularly surprising because I'm growing more and more concerned about the jobs market as compared to concerns about inflation. But inflation has been kind of stubbornly at this level, and moving it down further has just failed. So like if it stayed where it's at, it would probably be okay, but it could go just a little higher and all of a sudden it'd feel awfully uncomfortable.
So many of the statistics that the Federal Reserve rely on, they come from federal departments and federal surveys or federally funded surveys. So what impact has the federal shutdown had on this data?
Well, we're about to see and feel the impact a lot more from this point on. So we're going to start seeing more and more reports being missed that policymakers rely on to make decisions. So the most high profile one that we don't have at the moment that we would normally have by now is the jobs report. So this would say in each of the industries and overall that what's happening in the jobs market. And this is one of the main indicators that are looking at that policymakers look when they're setting uh, monetary policy, like interest rates and the size of the Federal Reserve's balance sheet, and the mortgage markets and that sort of thing. They really look at those numbers are just not available right now. And then also what we'll see here, unless something is resolved real quick, um, the future consumer price index numbers. But it's everything from consumer confidence that some of these things might, if there's vendors that are handling them, they might go ahead and keep them going on the promise or the hope that resources will be backfilled later on, but I think the longer it stretches out, the more likely it is that they'll be missing data. And so what it means is that policymakers will have to make decisions based on less information. The other thing that is going to, I think, is going to provide a challenge in the future is whenever things get resolved, and whenever they do, there'll be a kind of a catch-up period, and the information in the initial reports is probably going to be less reliable because of that. So I think we have two challenges. One is a lack of information, and then there'll be a catch-up period when the information that we get is probably less reliable than normal and might be into next year, early next year, before we see all these kind of cycles and reports and the modifications and adjustments all catch up.
All right, so you can't mention the federal shutdown without maybe offering some news on the latest. Any end in sight here?
Well, it's a complicated or tricky thing to assess because there's no outward signs that there's an imminent deal. So neither side has left themselves an escape route, a fallback position. Somebody just has to swallow and give on like what they previously described as an absolute demand in order for things to move forward. So in that sense, no end in sight. But the reason that I think that we can't be too far from an end is because the more serious ramifications where public pressure will start to mount on Congress and the president, those things will start to happen now. It's one thing to have short-term delays. It's one thing for stopgap measures to take the edge off impacts, but you are going to see now the broader scale impacts on more people. And as that happens and individuals reach out, the pressure will build on both sides of this equation. So you've got basically the the Senate Democrats who have some outsized power, if you will. They don't have majority control of the Senate, but they do have the ability to prevent passage on the final bill to fund government or do a continuation resolution because Republicans don't have a filibuster-proof majority, and so that there has to be a reckoning between the Senate Democrats in particular and, I want to say Republicans in Congress, but really it's the president. Those are the two that have the kind of power, if you will, whether it's formal or informal, to move things along. So those two parties, I think, have to feel more pressure for there to be a settlement of some sort. The biggest disagreement does seem to be on whether or not to continue the health insurance subsidies that were within the Affordable Care Act that were expanded during the pandemic. So you have the original healthcare subsidies from when President Obama was in office. There was some changes made along the way, but largely the same until the pandemic. As part of I forget the name of the big, there's a very big, one of the very big spending bills that came out of the pandemic expanded eligibility for subsidies on insurance bought on the exchange. And that had essentially an end date. And when the One Big Beautiful Bill Act passed earlier this year, it didn't make those pandemic era health insurance subsidies permanent, or essentially it expanded eligibility so more people could get the help in paying for their health insurance. And so that's really, as far as I can tell, like the main crux of the disagreement. Both sides are describing that disagreement very, very differently, of course, but until there's pressure on other things that are happening, like there'll be more disruptions probably with flights, for example, with air traffic controllers, not getting, they're mandatory, they have to come to work even if they're not getting paid. But I mean, that's going to get tougher and tougher. there's also food stamps, for example, even though they're administered by the state, they're paid for by the federal government. Most states are not in a position where they could continue those beyond if they weren't getting reimbursed, or they couldn't do it for long if they weren't getting reimbursed. And then in addition to like the healthcare items, there's a bunch of other things as well. But like if you need a passport renewed, that, these sorts of things, they you don't even really notice them until you're one of the people that needs it, and then all of a sudden it's like really, really important to you, and that's what I think will create the pressure. So in the one sense, there's no end in sight, but the things that I know are going to start happening and impacting people in the next few weeks, I think that will force a deal, and we're probably toward the tail end of this standoff, not because the parties have shown any signs of moving together, but because I think pressure is about to mount.
Brian, earlier you mentioned that the Federal Reserve Board appears to be more concerned about the economy than inflation right now, and that also matches your outlook. So, what are the warning signs you're seeing nationally and here in Michigan?
Yeah, I've been getting more and more concerned about the overall just condition of the economy and the jobs market in particular. And employment is such an important aspect of how people feel about the economy. And we do see a divergence of the overall condition of the economy if you measure it by economic activity or GDP and jobs. So in other words, we are in the middle of, or probably the front end actually, of a productivity revolution, more GDP with fewer people. That is likely the future. That has been the story of America actually going back 125 years, but I think that's really going to accelerate a period of real change. And so the jobs market in particular, more than the broader economy, I'm pretty concerned about. Um, Let me just run through a couple of the headlines that have happened here recently that go along and match pretty well with the anecdotal experience that we have engaging with just so many small business owners across the state. So the largest retailer now in the country is Amazon. Amazon has recently announced that they were going to cut about 30,000 jobs, lay off about 30,000 jobs. And they're citing a lot of different a lot of different factors in making that decision. But what really I think makes this more noteworthy than back in 2022 when they cut 27,000 jobs. So 30,000 jobs, about 10% of their workforce. 14,000 of them are corporate or management level positions. See, a lot of times when these big employers, if they're looking at, different changes and things, or if there's productivity improvements, or if there's questions about the economy, it won't necessarily hit the corporate suites as much as it does the ranks. And that is not the case here. And I think a pretty big impact or we're seeing these impacts mount up with respect to artificial intelligence. Another one in Grand Rapids, there was from Acrisure, which is a large insurance agent and kind of healthcare business. They do a lot of things, but cut hundreds of employees that was tied to technological advancements in automation and artificial intelligence in particular. There was one kind of counter, if you will, that I saw in Michigan recently, which was that American Axle, which is a big supplier, especially to General Motors, is expanding their plant and investing quite a bit, what did it say, $133 million in upgrades in Southwest Michigan, as their customers are starting to reshore or looking to avoid tariffs and have more of the processing happening local. So that's kind of counter, but General Motors itself announced that they're laying off, let me see, what did they say? It was going to be about 3,400 jobs, and a lot of them in Michigan, tied to slowing demand for electric vehicles in particular. But then there's also a requirement that companies that are going to lay off or are planning to lay people off, they file a certain notice with the state of Michigan, and those have started to come in more too. So Dana Thermal Products had sent a warn notice of layoffs to the state, and that was 200 employees. NPR of America, which is a Japanese auto parts manufacturer, notified the state that they're closing a plant in Grand Haven and terminating all 64 positions there. Ekbono Brake Corporation was another one, 48 employees in Farmington Hills, and DP World Logistics filed a warn notice affecting 70 positions in Warren. So to give you a sense, like there's big changes happening in the economy. There's changes happening in demand. There's changes happening in terms of the real fundamentals, and at a time when data is also going to be a little more scarce to come by. So all that to say, the Federal Reserve has at least signaled that they're more concerned about the jobs market than inflation, and I definitely agree with that. I think there's a lot more warnings on the jobs market side as compared to anything else right now.
All right, let's switch gears a little bit here and let's do an Election Watch 2026 update. A few weeks ago, we talked about the campaign finance reports from the US Senate candidates, but since then, the gubernatorial candidates have disclosed their fundraising activities as well. So, who's winning the financing race?
Okay, so this is there's a lot of different ways you can look at cash on hand, the total dollars raised. You can look at who the money was raised for, and we see all those dynamics at play here. But I think the fields are starting to shape up, and candidates are starting to separate themselves. Mike Cox, who former Attorney General, definitely has serious cash on hand. He gave his campaign another $2 million, and he had already given his campaign $1 million before. He's got 3.8 million on hand right now. So that puts him, if you look at cash on hand, pretty high. Now, not a lot of money raised from outside folks. Is mainly I would definitely characterize as more of a self-funder. The one who's generally accepted or believed to be leading on the Democratic side of the aisle, Jocelyn Benson, Secretary of State, raised more than $1.2 million over the last reporting period, which is about 3 months, and had about $3 million on hand. And Mike Duggan, independent candidate for governor, had 2.5 million on hand, and he raised about 1.2 million in that reporting period. The other Democrats running really struggled to raise money and make any sort of mark or announcement, which is a contrast from before, at least with Sheriff Swanson from Genesee County had, I thought, a surprisingly good fundraising haul in the previous report, but was far behind Benson in this one. Now on the Republican side, you've got Senate Minority Leader Eric Nesbitt. By the way, if you happen to be around Oakland County, you don't have a lot of time, but maybe you could check out our website. We're going to have Senator Nesbitt at a candidate forum tonight. But he had raised about 423,000. He has 2.1 million on hand, and so I would say that even though he raised a little less, he does seem to be spending less than others as well, and so it's that money that he's raising is accumulating. Former House Speaker Tom Leonard raised 290,000. He had about 709,000 on hand. He got in the race pretty late, and then. Let me see. I can't believe that I did not. Oh, here we go. Yeah. John James, who is, at least on the polling is leading on the Republican side. He raised 1.4 million. Now his campaign had been kind of quiet on fundraising for a while. So this was like a big push and a big move. He had 2.3 million on hand or in the bank. But one of the things that sort of separates him out, there's a friendly political action committee that has 5.1 million in it, ready to spend on his behalf. So cash-wise, it puts him in a really strong position. So those are the ones that I think are still in the race. There are others that are starting to get further behind on the dollars. And when you're further behind on the dollars, it means that you can't turn up the volume on your message later on when it matters the most.
All right, let's take a look at today's Data Monday report now.
All right. So I'm going to run through, we'll see how long it is before we do another one of these, but we had the inflation. Here's the inflation report. As usual, we've got the core, which is in orange, and the headline or the top level inflation with everything in this consumer's price index, both coming in at 3 for the month of September. And so again, if you look at it, like I saw a lot of stuff saying inflation is rising. Well, the last 2 months it did rise. So, but if you're to look at, this time period when the fiscal policy has been, pretty much the same, I don't know if it kind of just looks like it's in the same range that has become normal since it came down off the highs. Looking at it month by month, the headline inflation is at the top. That is the at 0.3 for the month, and CPI, it's a 0.3% increase for the month. But if you look at core 0.2, that's actually good. I prefer to see the core less than the headline inflation. And then here are the categories, just looking at, we show them year over year and month over month. And so as you can see, both of those looks here, there wasn't any kind of big movers on here that really surprised me. There are a couple of areas where like gasoline, for example, that the month numbers and the annual numbers kind of look like they're moving in opposite directions. I do think this is an important one to keep in mind. I show it to you almost every month, which is what's happening with inflation with goods and what's happening inflation with services. So there was a while when the inflation on goods had went down. Actually, we had deflation territory with tangible things, like actual things that you buy. Services stayed high, much higher for a while, and that certainly never got into deflationary territory, but have continued to kind of ramp down, although that rate at which it's ramping down has slowed. But you definitely can see when you look at inflation that it is still services that are keeping it above 3, not goods. And then this just shows the way that headline inflation, overall CPI has moved with the monetary policy of interest rates. And here's one that's, I came across this and wanted to share it with you. And my apologies if the picture is covering the most interesting part of this graph, but a couple of different things in 2023. We saw both the Fed tightening cycle, raising interest rates, happen, and then also the launch of the kind of original artificial intelligence system, and now there's so many different options that are on the scene. And look what's happened with total job openings since then. So those have definitely gone down, and yet the S&P 500, which is not a perfect proxy for corporate earnings, but you could generally, I don't think it's so unreasonable to kind of think of it in those terms, how well our corporation's doing. And this divergence I thought was quite breathtaking. So the Fed tightening cycle definitely correlates strongly with a reduction in total job openings. You would expect that. But that also happens to be around the time when artificial intelligence became more widely known and used. And that's why I just think it's going to be a really complicated time to know what's happening in the economy, because it's not just, is there demand for goods and services? That's usually how we think of whether the economy is strong. Are there demand for goods and services? If there are demand for goods and services, you need people to deliver those goods and services. And the idea that those things could move in opposite directions in the future is very plausible, and something that at least sort of looks like it's already happening. And but it's just hard to know. Correlation doesn't mean causation. And that chart just identifies a couple of different things that could be responsible for that divergence of how the S&P 500 have done, and then what has happened with job openings. So that's not the same as total employment. It's not that total employment has gone down, but as corporate stock prices at least have risen, which would suggest that those corporations are doing well, then the total number of new jobs has not tracked with that. I think it's a unique thing. It's a different experience as compared to at least recent decades. I didn't go back any further than that, but this is I think we're in store for a bumpy and unusual time period as we settle into a new normal.
All right, well, thanks for your insights, Brian. And thanks everybody for tuning in today. We hope you have a great week. We'll be back here next Monday at 3 o'clock.
Thanks, everybody. See you next week.